Credit is a powerful tool that can help you achieve your financial goals, whether it's buying a house, starting a business, or paying for education. However, not all types of credit are created equal, and it's essential to understand the different types of credit and how to use them wisely to avoid getting into debt and damaging your credit score. Here are the 4 most common types of credit and how to use them wisely. Revolving credit. Revolving credit allows you to borrow up to a certain limit, and you can use it as needed. The most common types of revolving credit are credit cards and lines of credit. These credit types typically come with high interest rates and fees, so it's essential to use them responsibly. To use revolving credit wisely, only charge what you can afford to pay off in full each month. This will help you avoid paying interest and fees, and it will also help you build your credit score. Additionally, avoid maxing out your credit card or line of credit, as this can hurt your credit utilization ratio, which is a critical factor in calculating your credit score. Installment credit. Installment credit is a loan that you borrow for a specific purpose and repay in fixed monthly installments. The most common types of installment credit are mortgages, auto loans, and personal loans. These loans come with lower interest rates than revolving credit, but they also come with stricter qualification requirements. To use installment credit wisely, make sure you can afford the monthly payments before taking out the loan. Also, make all payments on time to avoid late fees and protect your credit score. Secured credit. Secured credit requires collateral, such as a house or car, to back up the loan. This collateral acts as security for the lender and reduces their risk, which means you can usually borrow more money at lower interest rates than with unsecured credit. To use secured credit wisely, make sure you can afford the payments and that you're comfortable with the collateral requirement. If you default on the loan, the lender can repossess your collateral, which can have significant financial and personal consequences. Unsecured credit. Unsecured credit does not require collateral, and it's based solely on your creditworthiness. The most common types of unsecured credit are credit cards and personal loans. These loans typically come with higher interest rates than secured loans, and they can be harder to qualify for if you have poor credit. To use unsecured credit wisely, only borrow what you can afford to repay, and make all payments on time. Additionally, avoid applying for too much credit at once, as this can hurt your credit score and make it harder to get approved for future loans. In conclusion, credit can be a useful tool, but it's essential to understand the different types of credit and how to use them wisely. By using credit responsibly, you can improve your credit score, achieve your financial goals, and avoid getting into debt.